All right, let's jump right into this explainer. Today, we're putting Microsoft's staggering AI growth and its massive capital expenditures on the ultimate financial witness stand. We're looking at one of the absolute most fascinating disconnects in the market right now. On one hand, you have unprecedented, off-the-charts growth in their cloud and AI sectors. On the other hand, a jaw-dropping price tag to build out the infrastructure that actually powers it all. So, which narrative wins? Well, that is exactly what we're going to figure out today. Here is our roadmap for today. We have Section 1, the Microsoft snapshot. Section 2, the Warren Buffett lens. Section 3, the Peter Lynch lens. Section 4, the Benjamin Graham lens. Section 5, DCF and alternative valuation. And finally, Section 6, final synthesis and recommendation. Section 1, the Microsoft snapshot. Let's assess the starting line. Okay, check out these baseline financials because they are just massive. We're looking at a $2.77 trillion market cap behemoth, pulling in $82.9 billion in Q3 revenue alone. That's an 18% increase year over year. Diluted earnings per share hit $4.27, which is up 23%. This explosive growth is being driven largely by Azure and a sprawling AI business that just surpassed a $37 billion annualized run rate. Seriously, those are the kinds of numbers you'd expect from a nimble, hypergrowth startup, definitely not a mature tech giant. But here is where we find the central tension of our analysis. On one side, we have this incredible AI boom. Azure is up 40%, and Copilot is surging with over 20 million paid seats. But on the other side, a massive CapEx anchor. Microsoft is in the middle of a brutal $190 billion infrastructure spending cycle just to build out these AI data centers. Because of that incredibly heavy spending, their free cash flow dropped down to $15.8 billion. You are essentially watching a company spend historic, eye-watering amounts of cash today to guarantee their market dominance tomorrow. Section 2, the Warren Buffett lens. Moats, management, and margin of safety. So, how would the Oracle of Omaha view Microsoft? Well, applying Buffett's lens, we're looking for wide moats, manageable debt, and high return on equity. Microsoft clearly checks that moat box with Azure and its incredibly entrenched enterprise software. Their return on equity is stellar too, generating roughly $31.7 billion in quarterly net income, which annualizes to a fantastic 30%. And with $78.2 billion in cash dwarfing its $40.2 billion in total debt, the foundation is rock solid. Management has a very clear vision, even if it is, admittedly, deeply tethered to OpenAI right now. But wait, here's where we hit a bit of a snag. When we look for Buffett's all-important owner earnings, Q3 free cash flow dropped to just $15.8 billion. Why? Because of that massive capital expenditure cycle we just talked about. See, Buffett loves businesses that generate absolute mountains of cash without needing constant, huge reinvestment to maintain their edge. So without a hefty margin of safety baked into the stock price, Buffett might actually hold off buying at current levels. He'd probably wait for that cash flow to reaccelerate. Section 3, the Peter Lynch lens. Growth, categories, and the PEG ratio. Now, Peter Lynch famously categorized companies to understand how to value them. Normally, you'd think a $2.77 trillion company is what he'd call a stalwart, a slow, steady grower. But defying gravity, Microsoft's 23% EPS growth and 40% Azure growth recategorize it straight back into a Lynch fast grower. Lynch loves these kinds of companies for their explosive potential, provided, of course, that you don't wildly overpay for that growth. This brings us to Lynch's bread and butter, the PE ratio. If we take Microsoft's current, relatively low PE ratio of 21.8 and divide it by its impressive 23% earnings growth, we get a PE ratio of roughly 0.95. Anything under 1.0 is historically viewed by Lynch as a very strong buy signal. To find a mega-cap tech stock trading at a PE under 1 is remarkably rare, and it really suggests that the market might be severely underpricing Microsoft's near-term growth engine. Section 4. The Benjamin Graham lens. The defensive investor's strict checklist. Okay, time for the toughest judge in the room, the father of value investing. Running through Graham's defensive checklist, Microsoft passes the first 4 criteria with flying colors. Adequate size? Obviously. Strong financial condition? Yup. Current ratio is around 1.28. Great earnings stability and a solid dividend record, having just returned $10.2 billion to shareholders in Q3. But it completely fails his conservative valuation metrics. Graham wanted a PE under 15. Microsoft is sitting at 21.8. He wanted a price to book under 1.5. Microsoft is floating up around 6.6. Let's actually crunch the numbers on Graham's strict intrinsic value formula. We annualize that Q3 EPS to get about $17.08. Then we calculate the book value per share, taking equity divided by shares, which gets us roughly $55.70. If we plug those into his famous formula, the result may actually shock you. It spits out an intrinsic value of approximately $146, meaning Graham wouldn't touch this stock anywhere near its current price above $350. It's just way too expensive for a deep value investor. Section 5. DCF and Alternative Valuation. Projecting the future of AI cash flows. Graham's formula is arguably from a different era, so let's step into the present and look at a modern discounted cash flow model. To build our base case DCF, we absolutely have to account for reality. We must heavily discount the near-term years because they're severely depressed by that massive $190 billion AI data center spending cycle. For this model, we're assuming a 3% perpetual growth rate and a standard 9% weighted average cost of capital, or WACC. As you know, tech valuations are incredibly sensitive to your assumptions. Looking at the sensitivity table, our base case spits out a fair value of $305 per share. That suggests Microsoft is fully valued, or maybe even slightly overvalued right now in the $350 range. To justify current prices, you really have to assume aggressive, sustained growth, like a 4% perpetual rate, combined with a low 8% discount rate. That staggering CAPEX anchor really drags down the present value of the company. Interestingly, if we look at some other models, we get totally conflicting signals. Using a comparable PE model, Microsoft's current 21.8 multiple looks like an absolute bargain compared to its own historical 30x average. That model screams undervalued. But on the flip side, a dividend discount model, which values a stock purely based on the present value of its future dividends, screams overvalued. That's simply because Microsoft prioritizes reinvesting its cash into high-growth AI rather than paying out massive dividend yields. Section 6. Final Synthesis and Recommendation. Weighing the jury's verdicts. Bringing this whole gauntlet together, we have a highly mixed jury. Peter Lynch and the PE comparables model are loudly shouting buy because of that blistering growth. But Graham, our base DCF, and Warren Buffett demand a much better margin of safety, suggesting varying degrees of a hold or a sell. Buffett would likely want to see the price dip below $300 to account for that owner earnings hit, while Graham wouldn't touch it unless it crashed all the way down to $146. To make sense of all this, we really have to weigh the incredible strengths against the very real risks. The strengths are undeniable, right? A massive $627 billion commercial backlog, an AI business exploding at a $37 billion run rate, and Azure growing at 40%. But the risks are equally massive. That $190 billion CapEx cycle is currently crushing near-term free cash flow. Plus, 45% of that massive backlog is tied to a single customer, OpenAI. If that relationship falters, Microsoft feels it instantly. And let's not forget the gaming division, where Xbox hardware revenue is down 33%. So where does that leave us? Basically, our ultimate recommendation at the current price of $350 plus is a cautious hold. The business itself is fundamentally exceptional, but the market is demanding that you underwrite a historic capital expenditure cycle today for an AI payoff tomorrow, leaving us with one final question to ponder. Is Microsoft's AI moat truly worth paying the ultimate premium right now, or are we pricing in a future that won't pay out as cleanly as we hope? Think about how your own investment philosophy aligns with Buffett, Lynch, or Graham, and let that guide your verdict.